We believe the asset allocation opportunity today is truly the best we have seen in 20 years and is similar in magnitude to the one we saw in 2000. We've gotten here the hard way, with many of our asset allocation portfolios underperforming in ways that are frustrating for both us and our clients. It very much brings to mind the period that was the hardest in my career, the late 1990s. It was a very frustrating time, when just about everything we tried to do for our clients to make the money went against us. Our portfolios underperformed their benchmarks by amounts we would have considered unimaginable. And our clients, those who didn't fire us outright, became understandably frustrated and tired of us talking about how good the opportunities had become. One client, where we had come to speak to their investment committee on an annual basis for years, forbid Jeremy Grantham to speak to them again on the grounds that he was dangerously persuasive and totally wrong. Explaining that the forward-looking opportunity set was extremely good cut little ice with clients who believed we fundamentally didn't understand how markets had changed. Jeremy Grantham and I had worked out in a research paper in the middle 1990s that we believed the long-term additional return from asset allocation was perhaps 1% for a balanced portfolio and maybe 1.5% for a global equity portfolio. We had thought that that kind of outperformance was sustainable, and indeed in the middle 1990s, that's what our forecast suggested our portfolio should be able to do. But by the end of 1999, that opportunity set had soared higher, and the potential returns were around 3 times the levels they had been just a few years before. While we had trouble convincing our clients of this, our excitement was real. We can see the reason why in Exhibit 2, which shows the expected return of the asset allocation of our portfolios relative to their benchmarks. And as the bubble turned to bust in the middle of 2000, our belief was proven right. By the time of the bursting of the housing bubble in 2008-2009, our outperformance had been 3 or 4 times the drawdown we had suffered in the 1990s, as we can see in Exhibit 3. That strong performance allowed us to recast the late 1990s as both an anomalous period as well as the setup for an extremely strong period of outperformance. That outperformance had a downside, however, as our opportunity set fell all the way back to the baseline we had seen in the middle 1990s, as shown in Exhibit 4. At the time, we believed that while the glory days were behind us, we could still deliver the kind of long-term performance we had expected back in 1995 when we did our original analysis. But history has proved different. Since 2009, as the long bull market in US stocks and bonds has continued, we have underperformed again. While the magnitudes have not been quite as great as we saw in the late 1990s, the period of underperformance has been even longer, as you can see in Exhibit 5. This has led clients to fire us once again, and the remaining clients to become understandably frustrated and question whether the relative losses will be able to be recouped. There is certainly no guarantee that underperformance would create another 2000-like opportunity, where the gains can be much larger than the losses that created the opportunity in the first place. But we do believe that that opportunity is there today. The evolution of our opportunity set through the end of 2019 is shown in Exhibit 6. While the specific drivers of the opportunity are a little bit different than they were in 2000, value as a stock selection style is not quite as well positioned as it was then, but the regional differences between stock valuations are significantly wider than they were back in the TMT bubble. As a result, the opportunity set looks approximately as good as what it did at the height of that bubble. And we do have an advantage that we didn't have back then, as we now have a benchmark-free strategy which has more freedom to invest without worrying about tracking error to a traditional benchmark. We had not launched that strategy in 2000, but we can see the opportunity set for that portfolio since its launch in 2003. And today, we have clearly the best opportunity set we have had there since its inception. There are no guarantees that our forecasts will turn out to be correct this time in the way that they were correct in 2000. It is always possible that the world really has changed in a way that our forecasts do not recognize. But we believe that that is reasonably unlikely. I know from experience that it is not immensely satisfying to hear a manager wax enthusiastic about a portfolio that has been underperforming, but our excitement is genuine. We believe the opportunity today is truly the best we have seen in 20 years, and is similar in magnitude to the one we saw in 2000. After 10 years of failing to keep up with a long bull market, it is a hard time to be in the asset allocation business. But as asset allocation investors, the opportunities look about as good as any we have ever seen.